I think investor sentiment is very positive. Based on the GDP growth and the outlook for the year, based on the fact that we see those vacancy rates peaking and coming down, and based on the fact that people haven't been active for 2 or 3 years or not very active, then I think people are anxious to get moving and adjust their portfolios and deploy capital.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Richard Barkham, CBRE's chief economist. Richard is here to talk about key themes and trends for the economy and commercial real estate market in 2025. Richard, welcome back to the podcast.
Thank you. I'm delighted to be here.
So, Richard, can you set the stage for listeners in terms of how economic fundamentals are lining up for REITs and commercial real estate in early 2025?
I think it's all generally quite positive. If we look at 2024, we had above trend growth, quite a lot of good economic momentum, largely feeding through from a consumer sector, which is in reasonably good health. By which I mean that the consumer sector has solid balance sheets, it's got solid real income growth. And I'm not saying that there aren't parts of the consumer sector that haven't been squeezed by higher prices. I'm not saying that at all. But generally speaking, consumer spending, I think, looks quite robust as we go into 2025. And that's the bulk of the economy. And when you've got that kind of robustness in the consumer sector, then that feeds through into corporate earnings. And you've got a relatively good outlook for corporate earnings as well. So I think we believe that on that basis, we're going to get GDP growth in 2025 of about 2.3%. That's a bit above trend, a bit less than 2024, but nevertheless a good year in the economy, with, I think, the labour market firming up again, which had been a little bit weak. So that's all the economy. You asked me about real estate as well. And this is going to be a long answer. Feel free to chip in. So as far as the real estate sector is, I think we've had an end of cycle event really in real estate. By that, I mean over the last 2 to 3 years, in all sectors but retail and maybe some of the alternatives like data centers, we've had a rise in vacancy. And that vacancy, if we look at it in the office sector, the rise in vacancy has partly been due to weak demand, partly been due to new completions. But there's obviously been a structural shift in the way people work. So we've had vacancy rising from 12 to 20%. We've also had an increase in vacancy in the industrial sector and in the multifamily sector. Now, demand has been relatively robust in those sectors, but we've had a very elevated level of new construction, which is typically an end of cycle phenomenon. And of course, we've had a price drop, about 25 to 30% across most of real estate. And I think with that economic growth feeding through and continuing in 2025, I think we're seeing the start of a new cycle. Those end of cycle conditions are over really, and I think we're seeing the slow start to a new real estate cycle. We're seeing it in offices, we're probably seeing it in industrial, although that might be towards the end of the year. We'll be seeing it in multifamily, and by which I mean is vacancy will start to trend down, and rental growth, it's not going to accelerate away. And it never does at the start of a real estate cycle. But rental growth rents will be generally firm and trending up. So that's a long answer.
That's great. We're just over a week into a new U.S. administration. Broadly speaking, how do you see proposed new policies from President Trump impacting the commercial real estate sector?
It's a little early to say. I think Mr. Trump and his administration will pursue a pro-growth policies, by which I mean there will be a continuation of the tax cuts he enacted in his first administration, maybe some extra tax cuts. There will be generally a feel of deregulation, and I think those will be pro-growth. Now, there are other aspects of the administration's policies, tariffs. Now, we don't quite know how they are going to play out. I think the consensus suggests that maybe a bit less pronounced than current expression of those policies. And then we've got immigration, probably likely to trend down. I would say that those policies, but pursued in their fullness, those policies, I think, point to potential increases in prices. I'm not saying they're inflationary in the sense that they'll kick off a big round of 8 or 9% inflations we've seen over the last several years. But some of those, I think, could lead to some upward drift in prices, particularly immigration, the impact on the construction labor force. I mean, we've been through a period of quite pronounced labor costs, construction cost inflation. That's settled down now, but I think some of the constraints on immigration might have an impact on construction costs. Maybe tariffs will a little bit as well. But I think on balance, if I were to call it now, and I don't think I'm far from the consensus, I think that the new administration's pro-growth policies are going to dominate some of the other policies, such as constraints on immigration and tariffs. I think overall positive for the US economy. The thing that worries me, and I don't think it's a partisan issue, which is because I think I didn't hear either candidates really talk about it, is the fiscal deficit. The United States has a deficit of, however you measure it, 7 to 8% of GDP. And the interest that it's paying on national debt is accelerating or at least rising very strongly. And I think that will cause the 10-year Treasury rate to stay elevated above 4%, possibly even touch 5%. That's not in our house view, but I think there needs to be a credible plan for putting the government finances on a sustainable basis. I'm sure that will come, but we haven't heard about it yet. And I think that alongside the growth, I think we're going to have to deal with bond market volatility as a headwind in our sector over the next 12 or 24 months.
And do you see any of this having a noticeable impact on investor sentiment, or has it already been baked into expectations?
It's a big issue right now. We've just completed our investor intention survey, and obviously we're in touch with many investors. And I think investor sentiment is very positive. Based on the GDP growth and the outlook for the year, based on the fact that we see those vacancy rates peaking and coming down, and based on the fact that people haven't been active for 2 or 3 years, or not very active, then I think people are anxious to get moving and adjust their portfolios and deploy capital. We've had the 10-year Treasury up at these 4 to 5% levels for some years. So I think the investors are getting used to it. And the longer it's around, the more they get used to it. But I still think it will be a headwind for investors. We are seeing an uptick, I think, or our outlook is for an uptick in investor activity, particularly if we get good numbers on inflation. I think we will, at least over the course of 2025, notwithstanding what I said. Some of the policy impacts are likely to be longer term, but I think in the short and medium term, we're likely to continue to see inflation drifting down. That will be positive for sentiment. But as I say, overall, the positives outweigh the negatives of elevated bond rates. An improvement in investor activity in 2025 is what we think will happen.
Great. And that was something I wanted to ask you about, the capital markets, what you were expecting and how that would translate into transaction activity.
That's about the point I was making. Somewhere between 5 and 10%, there is some upside associated with that. And as I say, investors are motivated. Economic growth and corporate sentiment is improving. They're all positives. But the volatility in the bond market does just act as a minor restraint, or perhaps a little bit stronger than that, on investor activity.
And turning to specific sectors, is there a property group that you feel could be particularly noteworthy this year?
I think they're all good sectors in their own way. It depends what sort of level of risk and what sort of level of active management that you want to deploy. And I know REITs are formidable active managers. I would point to the retail sector. I mentioned the rise in vacancy that we've seen across all sectors over the last several years. We haven't seen that in retail. Retail vacancy has tended to trend down, and because we haven't built any, we have, but not a lot of retail over the last 10 to 15 years. Not only that, the consumer is strong. And not only that, I think retailers themselves are actually better than they used to be. They went through this COVID trauma. A lot of them went into sort of bankruptcy or administration, restructured their balance sheets. And I think a lot of them have also realized and achieved very slick omni-channel business models now. So I think the retail sector as well as the fact that its cap rates were not as depressed as other sectors prior to COVID. I think the fundamentals of the retail sector are extremely good. Now, I will say we're not going back to the glory days of the 80s and the 90s in the retail sector when landlords could achieve any rent that they wanted because retailers were expanding. I think retailers are very savvy nowadays. I think they really understand. The data is so good. They understand their catchment areas. They know how much money they can make in any particular catchment area, and they know they can pay 12.5% of that in rent. I don't think retail owners are able to push the rent aggressively, but the fundamentals are very strong. In some senses, I think where leasing activity is being held up by lack of good available space. So I'd probably spike out the retail sector, but I wouldn't want to say that the multifamily sector, it's had a historic level of new completions in 24 and 25, and to a certain extent that will continue throughout 25. But America is short of 3 to 5 million homes. And with mortgage costs elevated and unemployment low, that people are forming households. People are moving into their own units. And all of that demand is going into the multifamily sector. And I think some of the press stories around the Sunbelt, elevated supply in the Sunbelt, they're true. But all of those vacancy rates have peaked now and are coming down. So it'll take a while for that stock to be absorbed, maybe 12 months or so. But it's a good time to be a renter in the Sunbelt. And that's where the US population is heading. So I think the outlook for the multifamily sector is good. I think in terms of the industrial sector, we've forecast, I think, a solid year. Now, I don't think we're going to see the level of leasing in the industrial sector that we saw during the pandemic. That was so elevated. We may even see some sort of fall in leasing, overall leasing, but it will still be a strong year for industrial leasing. And I think what we're seeing in that particular market is just as in the office sector, we're seeing flight to quality. So I think we're seeing industrial space users moving from older properties, taking advantage of the new space that's being completed. So I think net absorption will be positive but low. Gross absorption may not be quite as high as last year, but still be very solid. Vacancy will probably continue to rise over the course of the year, but not very fast, and will peak out in 25 and start to come down. And then there's the office sector as well, obviously being very challenged, but we've seen a terrific level of leasing in 2024, and I think that's likely to continue. Partly that is just confidence coming back into the sector and confidence about how the office is going to be used. It remains central to companies' operating platforms. I don't know that we're going to go back to 4 and a bit days in the office. We might settle around 3 and a bit days in the office. But the number of jobs in the office using sectors has gone up. And the number of completions, I think, would have been around 45, 50 million in 2024. It's going to be 15 million this year. And new construction has tailed off. Again, we've had the flight to quality, which has dominated leasing, continues. And I think what we're going to see, oddly enough, we will see vacancy come down from 20% in the office sector slowly. But I could see in the course of 2025 a real shortage of the grade A quality, of the prime quality space that companies want to occupy. We're going to be in a strange old world, I think, where we've got too much office space, but not enough of the right kind. So I think, and occupiers are realizing that. They realize if they want to secure new space or they want to shift into better space, they need to move quite quickly. In any case, we're seeing a resurgence of office leasing, which is going to, I think, drive rents in the higher grade echelons of the office sector.
And one other sector, the data center sector, which we've seen tech stocks come under pressure because of this, the outlook for AI, this new Chinese app that potentially could reduce the need for space and energy. So just wondering if that's an immediate concern or more of a longer term concern.
Look, the data center market has been on an absolute tear for 36 months, probably a little bit longer than that. We've got rents going up. We have got a very vigorous construction pipeline and seemingly endless demand. I have to say that I'm always a bit suspicious when people start talking about endless demand. And I've always had at the back of my mind the possibility that there might be productivity gains in computing. So the demand for storage relative to output of cloud and AI services might fall. And I think that's what DeepSeek, that's what's worrying, I think, about DeepSeek. But I don't see a world in which data is going to be less important. If you look at the training requirements for AI models are on data, they're huge. And I think we're nowhere near fully training up AI. I think DeepSeek is an issue for the sector because you just might get more computing power there's productivity gains in computing. It might impact on demand. But I think it's not just AI that's driving data center demand, it's overall cloud computing as well. I think we need to watch that, but I still foresee a relatively robust year for data center demand in 2025.
Excellent. Richard, we've covered lots of sectors and topics. Anything you'd like to add?
I've talked about this a little bit in some of the non-standard CBRE material. I think one thing that I'm beginning to see is just a revival and renaissance in American cities, which were knocked about quite severely by COVID and then loss of function through people using the office less. And it was a bit of a surprise to me that American cities took so long to recover relative to European cities. But everywhere I look now, you see really promising signs of life. Some cities are ahead of others, but you see it in the formation of new restaurants, you see it in street life, and you actually see it in the multifamily sector. People still want to live in cities. So I would say that revival of American cities it's a complex investment thesis, and it's not a straightforward buy this, that, or the other. But I think if investors can participate in the revival of American cities, then there are long-term good gains to be made out of that.
We'll end it there. Thank you, Richard, so much.
Pleasure.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.